This tutorial, presented by the University of Wyoming Delta Alpha Chapter, illustrates journal entries relating to sales and returns. When making journal entries, always keep in mind the basic accounting equation: assets equals liabilities plus owner's equity. Asset accounts have a debit balance. That means to increase an asset account, you make a debit entry, and to decrease an asset account, you make a credit entry. Liabilities and owner's equity accounts have a credit balance. To increase these accounts, a credit entry is made. To decrease these accounts, a debit entry is made. On the first day of operations, our company sold 400 shirts on account to Kids Company for $7.50 each. For this sale, no discounts were available. The accounts affected in this transaction are accounts receivable, which is an asset account, and sales, which is an owner's equity account. To record this sale, we will debit the asset account, accounts receivable, for $3,000, and to record the increase in sales, we will record this as a credit. On day 10, we received payment from Kits for the sale we just recorded. The two accounts affected are both asset accounts, cash and accounts receivable. Cash is increased by $3,000, and our accounts receivable is decreased by $3,000. To record this transaction, cash is increased by $3,000 by a debit entry. Accounts receivable is decreased by $3,000 through the credit entry. On day 11, Kids returned 10 shirts for a cash refund. Two accounts are affected in this transaction: the cash account and the sales, returns, and allowances. The cash account is an asset account that is decreased by $75. The sales, returns, and allowances account is a contra owner's equity account. As you remember, a contra owner's equity account has a normal debit balance. To record this transaction, we record sales and returns allowances as a debit to increase this amount, and we record cash as a credit to decrease this amount. On day 19, we sold 2 shirts off of the discount rack. Each shirt was priced at $2 each. The accounts affected in this transaction are cash and sales. Our cash is increased by $4, so we make a debit entry. Our sales are also increased by $4, so we make a credit entry. Our company records sales monthly, with the exception of specialty sales, which are recorded at the time of sale. On day 26, we are going to record our monthly sales. The sales totaled $5,000 this month. Of that, $2,000 were cash sales, $2,500 were sales on account, and $500 were sold by credit card. To record this transaction, our cash account increases by $2,000. Our accounts receivable increases by $2,500, and our credit card receivables increase by $500, all asset accounts. Our sales account, an owner's equity account, increases by $5,000 in this credit entry. Remember, on day 26, there was a bank card fee of 2% on our total credit card sales. To record this entry, or this transaction, we have a bank card expense of $10 and a cash decrease of $10. Our company accounts for inventory using the LIFO method. The LIFO method assumes that the inventory purchased last is the first that is sold. Our company purchased t-shirt and logos on 2 different dates at 2 different prices, as you can see. For this example, we assumed we sold 525 shirts, assuming 1 logo on each shirt. To calculate the cost of goods sold, we need to calculate the cost of shirts and the cost of logos. Using the LIFO method, we are going to sell the inventory purchased last first. For our t-shirts, we are going to sell 400 at a cost of $5.25 each, and we're going to sell 125 shirts at a cost of $5 each. For our logos, we are going to sell $300 logos at 45 cents each, and using the LIFO method, we'll finish by selling 225 logos at 30 cents each. To record this entry, we are going to have a cost of goods sold of $2,927.50 as our debit, and our inventories are going to decrease. When recording journal entries, our advice to you is to remember that the debit entry will be what you receive and the credit entry is what you give up in exchange.